What's up, everybody? The Buffett Indicator has reached an all-time high. Many people are saying that the market is overvalued. I've seen two articles just in the past week saying that there is a crash coming. So we're going to talk about what is the Buffett Indicator, what does it tell us, what does it not tell us, and most importantly, what should we be doing today? If you get value out of the video, subscribe to the channel. Now let's get into it. First of all, what is the Buffett Indicator? The Buffett Indicator is a ratio of the market cap of all publicly traded U.S. companies divided by the US GDP. So basically divided by the value of all the stuff that's created in the US. The simple idea is that when that is high, the market might be overvalued, and when that's low, the market might be undervalued. Now, I should mention, Warren Buffett almost never talks about this metric. You listen to him speak, you read his letters. This is just not a metric that he commonly refers to. But it's called the Buffett Indicator because in an article in 2001, this is about, a little over a year after the dot-com bubble crashed, Warren Buffett said, hey, look, if you just take the value of all US stocks and then you divide that by the gross national product, he was using GNP instead of GDP. They're very similar. There is a difference. We'll talk about that in a second. But basically he said, if you just look at this, when this reaches some extreme level, like near 200%, then in his words, you are playing with fire. He says if you buy between the 70 to 80% area, it's likely to work out well for you. We can see historically, looking at this graph here, it looks like it's been between 40 and 80% for most of the time. But this doesn't look at the last 25 years. Remember, this article was 2001. If we see more recently, it looks like this has basically been trending up. Right now, we are well above the levels we saw in even the dot-com bubble. So you might look at this and say that the market is overvalued right now. But, there's a few reasons why we might expect this ratio to actually trend up over time that have nothing to do with overvaluation. First of all, if the percent of just like total business in the US that's linked to public companies, if that's going up over time, so if there's fewer, mom and pop shops, if just a smaller share of the business pie is being conducted by, private businesses or individually owned businesses, then you would expect this ratio to go up. And indeed, public companies have penetrated more and more of American business. Now, another reason why you would expect this ratio to go up is, a lot of US companies, their business isn't necessarily in the US. Nowadays, I think about a third of the revenue of the S&P 500 comes from international, comes from outside of the US. That's a lot higher than it was back in 2001. That's been going up over time. And if an American company is selling goods in, France or China, that's not being captured by US GDP. Now, interestingly, it actually is included in GNP. So just to talk really briefly about the difference between GDP and GNP, GDP, gross domestic product, that's the value of all goods and services that are within a country, produced within the US borders. So if Lululemon manufactures pants in Vietnam and they're sold in the UK, that has no effect on the US GDP. But the GNP is the value of all goods and services that are produced by US citizens and companies. So if you're just comparing market cap to GDP, as companies become more and more international, you would expect this ratio to head up over time. Maybe people who are looking at the Buffett Indicator nowadays should look at what Warren Buffett actually said and use his ratio, value of US stocks to GNP. In any case, we've reached something like 209% on this ratio now in July. What does that mean for the future of stocks? Well, first of all, what it doesn't predict is a market crash. Valuation is a pretty poor predictor of short-term market moves, and even in terms of medium-term market moves, if you decided that every time this ratio was above 150% that you would just sell, you would have missed out on the last 5 years of the market, which would have been a very good time to be invested. I'm not sure how useful this one metric is. I think people only really focus on it because Warren Buffett mentioned it once and it has his name associated with it. If you look, on the other hand, of what Warren Buffett actually does, Warren Buffett buys undervalued companies. He's not buying the whole market. He's looking at individual companies and he's trying to find value opportunities. When Warren Buffett started out and he wasn't working with massive amounts of capital, he was looking for deep value opportunities. He was an OG deep value investor. The stock market is just a big old basket of a bunch of individual companies. Some you might think are overvalued, some you might think are undervalued. Now, to quickly address the question that you might be wondering if you're looking at the Buffett Indicator of, is the market overvalued today? Is the market expensive today? I actually have taken a look at the S&P 500 as a whole. The S&P 500 is like 80% of the total US market. So this basically is the US market. And the valuation right now is pretty rich. It does look pretty expensive. I think our expected returns in the market for the next 5 years are very likely to underperform the return we've gotten over the past 10 years in the market. just to show you some assumptions for what I think you might expect investing in the S&P 500. I mean, if we assume that revenues grow 4.5%, which is a little more than what it's been historically, if margins go up a little bit from where they are right now, which again is very high historically, margins have been going up over time, and if we give the market a multiple in the low 20s, which is not some astronomically high valuation, but is also not some very conservative valuation either, then with these assumptions, you'd expect just 2.5%-ish annualized on your investment. So underperforming just some money market fund. I mean, you see the assumptions we have to make just to get a 10% return. Revenue growth would have to accelerate to 6% every year for the next 5 years. Net income margin would have to reach new record levels, and we'd have to keep a really steep valuation, 28 times earnings for the total market. And yeah, if that comes true, you're going to get 10% on your money investing in the S&P 500. This is certainly possible, but I can't help but look at this and say that the risk reward for the S&P 500 right now is really poor. And as we saw when we recently looked at JP Morgan's guide to the market, there has in fact historically never been a time when the market has been at its current price to earnings multiple where we've achieved a 10% annualized return over the next 5 years. So all in all, I would say yes, the market does look very expensive, whether you're looking at this with, the Buffett Indicator or however else you're valuing markets. So that brings us to the actual important question, which is what do we do about it? Well, in keeping with the theme of the video, let's go back to what Warren Buffett actually does. He buys individual undervalued companies. And that's what I think we should do as well. Yes, the market looks expensive, but expensive or not, I'm going to be hunting for deep value opportunities. I don't know if we're going to have a market crash in the next year, 2 years, 5 years. I can guarantee that there will be more market crashes in the future, but if we sit on the sidelines because some indicator says that the market is really expensive, I think you're much more likely than not to lose out in the long run. So that's all I got for the video today. We'll be talking more about some specific deep value opportunities soon. If you got some value here, subscribe to the channel. We are almost at 400 subscribers, so thank you to everyone who has watched, and I hope to see you in another video.